Hey, everybody, welcome to the market update for today, December 19th, 2022. We're going to be talking about uh, rates, recession, and housing. Three important topics that everybody wants to know about these days. Everyone's looking to understand what's happening with mortgage rates, what's happening with inflation, how is that going to affect a recession, housing, all those good things. So we're going to touch on all those topics here today to try to help inform you about what is going on in the marketplace and why are we experiencing what we're experiencing and what can we expect going forward. So first thing I think that it's important to talk about is what is inflation? A lot of people have a firsthand experience of what inflation is. Obviously, the cost of everything going up. We experience it when we go to the gas pump, when we go to the grocery store, when we go to purchase just about anything, we see prices going up constantly. And yet the thing that most people don't understand is why. Inflation is technically defined as too many dollars chasing too few goods. It's really as simple as supply and demand. When there is too much money in circulation in the economy and the goods are not plentiful enough to keep up with that supply, it drives up the cost of those goods. And that's what we're experiencing right now. We know that during COVID, everything was shut down. There was supply chain disruptions. The goods and services were not flowing as they normally do. And then the government came in and injected the economy with massive amounts of spending. Some of it was, necessary to help people that had their jobs basically shut down or locked down. But there was a lot of extra spending that was going on that was really not necessary. And then as we moved past the points of desperation where there was some things opening up, the government decided in their infinite wisdom to continue to pass a huge spending bill, again, injecting more money into the economy, which really put us into the situation that we're into now. A lot of people think that the Fed is the ones that have the control over what's happening in the market, how they influence interest rates, and it's really not true. Inflation is the key factor that determines mortgage rates. Now, what the Fed does have control over is what's called the Fed funds rate. The Fed funds rate is an overnight lending rate that banks charge each other to meet their capital reserve requirements. It is not what banks charge consumers or businesses, and it has no impact directly on mortgage rates. The only mortgage that's impacted by the Fed moving interest rates is home equity lines of credit. So the Fed funds rate has a direct impact on the prime rate, and the prime rate is the index that is used to determine your interest rate on a home equity line of credit. It also impacts credit card rates. So those are two things that see a direct correlation between what the Fed does and what interest rates are on those. It also impacts commercial lending. So commercial lending is impacted pretty substantially. The reason that we've seen mortgage rates go up is really explained if you look at this graph here. If you go back to 2020, in the beginning of 2020, this vertical bar here is actually when we had a recession. Most people don't realize it. It actually happened before COVID. But the purple line here is a 30-year fixed rate mortgage. It was hovering in the mid 3s to 4 range before that. And it stayed in that range until we got to late spring of 2020. And you can see during that recessionary period, what happened is during the spring, the stock market and the mortgage-backed securities and treasuries market had a huge disruption. I'm not going to get into the details about what transpired, but the Fed had to come in and provide massive amounts of liquidity to those markets. The first thing that they did is they dropped that Fed funds rate down to 0 to 0.25%. So you see that green line here is the consumer price index. It saw the CPI, which is the measure of inflation, drop in correlation with the Fed funds rate dropping. At that same time, the Fed started to buy mortgage-backed securities and treasuries in massive quantities because as we saw mortgage rates drop, based upon the inflation dropping, you see the CPI numbers going down early 2020. That inflation drop causes mortgage rates to drop, caused the Feds to drop rates and buy up mortgage-backed securities, which dropped interest rates on mortgages even further. So we saw that period of time where We started to see mortgage rates drop into the low 3s and the high 2s. And during this period on the chart where it says the QE period, that's called quantitative easing. That means the Fed buying up these mortgage-backed securities so that mortgage companies can continue making loans to effectively lower people's interest rate, increase their cash flow on a monthly basis, putting more money into the economy, stimulating the economy so that we could get through those COVID issues. So that's what was happening during that period. But then you'll notice in 2021, we started to see this green line go up. Again, that's the CPI number. That's the measure of inflation. During 2021, we started to see inflation going up because they were still pouring more and more money into the economy. We had supply chain disruptions. Those things were not getting any better. You remember all of the shipping containers in the ports and off the coast of China that were getting held up. So we were starting to have real big problems. And the Fed thought that this was going to be a transitory situation, that inflation rising as rapidly as it was during that time period was going to be transitory. They thought as soon as the supply chains would be opened up, that inflation would come back under control. They couldn't have been more wrong. As you can see from the chart here, all the way through the end of 2021 and into January of 2022, and then beyond up until really recently, that CPI number has continued to go up astronomically. And this is where we started to feel all the pain with it. But you'll notice not until we got into January of 2022 and a couple months after did the Fed actually realize they made a mistake. This was not a transitory situation, and they stopped buying mortgage-backed securities. So you'll see right after that point is when the interest rates on mortgages started to shoot up. And that's because the biggest buyer of mortgage-backed securities was the Fed, and they stopped buying mortgage-backed securities. So now you take the biggest buyer off the table, now there's not as much demand for those mortgage-backed securities. So what lenders have to do is they have to make loans at higher interest rates in order to attract buyers to buy those loans, to pay them back in order to make more loans, because mortgage companies are in the business of making loans. They only make money when they make new loans. They don't make money off of collecting payments. That's where long-term investors make their money, is off the payments and the interest received. So there was just massive disruption in the marketplace. And that's when we started seeing in 2022 massive increases in mortgage interest rates, and the Fed having to finally stop buying mortgage-backed securities. But by that point, the consumer price index was kind of out of control. Inflation was kind of out of control. And the next thing that everybody wonders is, when is this inflation thing going to peak? We may have actually already seen it. And the reason we feel like that's a good possibility is by looking at the chart and understanding what this all means. There are two CPI numbers, two measures of inflation. There's the headline inflation number, and then there's the core rate of inflation. The core rate is what's important to the Fed because it strips out energy and food prices. Those are things that the Fed can't control. Things like international conflicts, war in Ukraine, weather patterns, things like that can really cause a big disruption, and the Fed can't impact those. So they really just look at the core CPI number, which is the number that's important to them. And if you look at this chart, what it shows you is each of these months, it shows you the month over month inflation rate. The year over year inflation rate is really just the sum of the last 12 months of monthly figures. So it's a 12-month rolling average. If you look back in July, August, and September of 2021 on the left side of the chart here, what that shows you is the monthly inflation figures. Again, this was the transitory, quote unquote, transitory period that the Fed stated. Those were low inflation numbers. Then all of a sudden they started to elevate in October, November, December of 2021, January, February. All those months were either 0.5 or 0.6 month over month inflation figures. If you just multiply that times 12, that gets you to the point where you're seeing that, 6 to 7% inflation figures there. In March, it dropped down to 0.3, then back up in April, May, June was the height of the month over month figure being at 0.7%. You'll remember maybe back in July that you started hearing some people say, well, oh no, we think it's peaked. We got a low reading in July, and then it shot back up in August. Now, if you go back 1 year prior, you'll see that July was not impacting the year over year figure because it was The 0.3 reading in July of 2022 was replacing a 0.3 reading in July of 2021. Same number, didn't have an impact on the year-over-year inflation figures. Then in August of 2021, there was a 0.2 reading, but in 2022 was a 0.6 reading. So that made an increase of 0.4% on the year-over-year figure. Then in September, we had another 0.6 reading, replacing a 0.3 reading. That was another 0.3% increase. So we started to see those rapid increases of the year-over-year numbers, and they started to realize that, hey, wait a minute, maybe we're not done with this yet. Now, what we have looked at, and I'll give credit to Dan and Barry Habib at MBS Highway for really directing a lot of our attention in the mortgage industry to this, is that they saw what the figures were for October, November, December, January, February, all residing in that 0.5 to 0.6 neighborhood. They were predicting that in October, November, December, we were probably going to start seeing some decreases in the year-over-year inflation numbers based upon lower monthly inflation numbers, because we've had a series of months of increases in the Fed funds rate. And the Fed funds rate is designed to slow down the economy. They make borrowing more expensive, so people take less money in the form of borrowing and credit, and therefore spend less money, takes money out of the economy, slows down the economy, and they knew it would have an impact. It just took a while for it to actually have an impact. But based upon that assumption that rates on inflation month over month were going to be lower, that October figure of 0.3% replaced an October figure of 0.6%. We saw a 0.3% decrease. Then in November, a 0.2 reading that we just got replaced a 0.5, another 0.3% decrease in the year-over-year number. We've gotten down to a 6% year-over-year number. If you take a 0.2 reading and you multiply that times 12 months, you're going to see we're not looking too bad on year-over-year figures. We're probably looking in the neighborhood of just over 2% inflation on the core reading, which is about where the Fed is looking for it. So as we have these higher readings over the next few months of 2021, if we get low readings in 2022 that are replacing those, we should start to see some significant decrease in the year-over-year consumer price index core reading. The next meeting is not going to be until February. We will have CPI readings in January. That'll give us some more data to see if this looks like the end of the high inflation figures. And based upon that, when we have those inflation figures coming down, we should start to see mortgage rates coming down. Now, the next thing that people wonder about is recession. You hear a lot of talk about it, you've heard about it for quite some time, and people worry about a recession. How is that going to impact things? And the reason we have a very strong opinion about us ending up in a recession is because the Fed has pretty much laid the groundwork and the foundation for Fed rate increases and the propensity to cause inflations throughout history. All these vertical lines are recessions on the chart here. The purple line is the Fed funds rate. So if you look before each vertical bar, you're going to see that there was hiking of the Fed funds rate prior to going into recession. That's because inflation was high. The Fed increased the Fed funds rate to slow down the economy. It's an effective tool, and it drives the economy down and throws us into a recessionary period. So every single time you see Fed funds rate increases, go into recession, increase recession, increase recession, increase recession, increase recession, and again here. So we have a very, very strong indication that we are going to be heading into a recession. And then the reason that we also know that is if we look at unemployment figures, we can see that every time unemployment gets very low, as soon as it starts to tick up, that's when we start to see a recession. Again, recession indicated by the vertical bars here, and then the unemployment rate is the purple line here. So you can see prior to every recession, unemployment was at a low point. Then we end up in a recession, and then unemployment starts going up. And that's because as unemployment is low and the economy starts to turn, then we start to see layoffs. People stop spending as much money because they're without a job, which increases the recessionary pressures, and that leads to more layoffs. So it is a self-fulfilling cycle that happens every single time. We're again at a very low point in unemployment figures. They have started to tick the other way. It's another good indication that a recession is coming. So everyone wants to know, what happens with mortgage rates if we do go into recession? Are they going to go up or are they going to go down? And again, if we look at history, we look back to 1980 recessionary periods, we can see that from the beginning to the end of the recessionary periods, every time interest rates on mortgages have gone down. And again, that's simply because during a recession, the economy, it condenses, it slows down, there's less money flowing. And as a result of that, the Fed has to start lowering the Fed funds rate. When inflation comes down, mortgage rates come down. They try to make borrowing less expensive in all ways so that they can spur on the economy and bring it back out of a recession. So we have a high confidence level that we're going to be in a recession, and that during that recession, interest rates will come down. So that's actually very good news for us all to be looking forward to, even though recessions are bad and they definitely cause some pain with job losses. We know the Fed's goal is to create job losses. There is a silver lining to it, that mortgage rates should come down, and that provides opportunity for people who have purchased a home in the last year to be able to refinance and get into lower interest rates. Please, if you have questions about this, I'd love to share facts and data to support the opinions. You hear a lot of people in real estate talking about these opinions, that housing is going to be strong, rates are going to come down, but not a lot of people actually explain why. What is the data that we're relying upon? What is the past history that we're relying upon to formulate these opinions? And that's where I wanted to bring you today, is the facts and figures that tell us housing is going to be strong, interest rates are going to come down. If you have questions about any of this stuff, feel free to reach out at any time. Take care.